Right, so this is a question review of the latest exam. And so I am on the practice platform and the new ISS practice platform, which functions slightly differently from TestReach. And so you have to browse available exams through strategic business reporting, click on the international variant, and then all the exams will come up. And then you need to assign them to yourself. So I've assigned myself March-June 2025. So if I click on it, it says I've already assigned it. And then you go view assignments. And under strategic business reporting, we've got 11 assignments, which I've assigned myself, obviously, all the ones available for me. And I am looking now at the March-June 2025, and I'm going to go through question 1. So once you resume it, here it is, it's already here for me. And this question 1 is a typical question 1, and it's asking us to do a change in group structure, a defined benefit plan, and we're also going to be using the pre-populated spreadsheet to put through errors. So I thought it'd be good to show you this because this is the type of thing you're going to be doing in your tuition mock, okay? So let's have a look at the requirements first of all. Always look at the requirements first of all. So pulling up the requirements is not making it very big, unfortunately. It says, using Exhibit 1, explain with calculations and in accordance with IFRS accounting standards how to correct the accounting treatment of the investments in BRIN in the consolidated financial statements. Now, that's the first thing you need to focus on, consolidated financial statements. So it doesn't just mean whatever they give you here in the pre-populated spreadsheet. So in the pre-populated spreadsheet, you can see they've given you a statement of financial position. They don't, marks are going, therefore, for talking about what's going on in the profit and loss as well as the statement of financial position, because they've asked you for the consolidated statements for the year. And even that could even say cash flows. So there will be marks going for not just talking about the statement of financial position. Your answer should include a revised calculation of goodwill arising on the acquisition of BRIN. So we need to do a revised calculation. Now remember, you've got a word processor and you've got a spreadsheet. Absolutely fine to do the calculations in the spreadsheet and reference anything in your word processor to it. That's probably a really good exam technique to do. All right. Now there's 10 marks going. It's asking for calculations. So again, when you're writing your answer, you can reference any calculations in the spreadsheet. Sometimes it might be quicker to write them out in the word processor, but you just have to decide for yourself. Because then if you jump down to part C, it does say using exhibits 1, i.e. talking about 1, and your previous answers 1 and 2, adjust the pre-populated spreadsheet to correct the draft statement. So these are where you're going to be putting journals through, okay, in this pre-populated spreadsheet to correct it. All right, so it's keeping your wits about you, I think, really. So doing it in conjunction is a good idea. Let's now look at 2. It says using Exhibit 2, explain with calculations in accordance with employee benefits how to account for the defined benefit plan. So we need to explain how to account for the defined benefit plan, do some calculations, and then put the adjustments through to get those marks in part C. So hopefully everybody's a bit clearer on that. Now, the first thing we always do, now, if I'm able to do this, because in TestReach you used to be able to do, it used to be a lot easier, I'm going to copy that, click open my word processor, and I'm going to try and paste it in. And it doesn't work, so I'm just going to paste this way, see if it works that way. No, so I need to now work out how to do this. I did it the other day. Let's did it in my Mac, so, and then I'm going to try and do this. Unfortunately, this does not work like the exam. Oh, good. Right, I had to do Control-C to put that into my word processor. So I always want to paste my paste the requirements into the word processor so that when I start typing underneath this, I therefore know they know which part of the exam I'm doing. Okay, so I would start typing here. Okay, so I'm now going to open up the exhibit Always reference the question when you're opening up the exhibits just to check. They want me to explain how to account for the investment in Bryn for the year ended 31st December and recalculate goodwill. So if we look here, on the 1st of January, Egap paid 4.3 million to acquire 25% of the 5 million equity shares of Bryn. This shareholder enabled it to exercise significant influence. Therefore, that is giving us an indication, everybody happy, if I highlight that this is now an associate. Egap recorded this investment in Bryn at cost within the draft consolidated financial statements, and no further entries have been recognised. So that's the first thing we need to write about. We need to write about the fact that this is an associate. We need to say it's got significant influence, and we need to say it's got 25%. Therefore, it should be equity accounted. And we need to adjust for that. And that's what will be required in the pre-populated spreadsheet. And we need to do a working to show what we need to have in for that. Okay, so that's the first thing we need to do for the first bit. So I can't copy and paste, unfortunately, everybody, into this, which is really annoying me. So you can't now copy and paste. Now, I know why they've done this. You can't copy and paste because I've obviously pre-prepared my answer, right? So you can't copy and paste into here anymore. I think they've done this to avoid sort of cheating on the practice platform. So I'm going to put my Word document up, which I can copy and paste into because it's going to take me ages to type, and I'm trying to do a question debrief here. So what I'm going to say for this first bit, I just need to get some of my things out the way here, is this is what we're going to say. And I'm going to refer to it in the first bit. We're going to say, here we go. This is how you answer the first bit, which is to do with the associate. So the first bit, we would say, to get the marks for this section, and remember there's 10 marks going. On the 1st of January, it had significant influence over Bryn. Now, can you see what they put in brackets? You don't need to do that. You just need to see Egap had significant influence over Bryn. What they're trying to do is just trying to keep it short, give you references. Don't worry about that. Bryn, and should have classified the investment as an associate rather than a financial asset. 1 mark. As an associate, it should be accounted for using the equity method in the consolidated financial statements. And so the share of profits generated by Bryn since acquisition, and I'm going to show you how you calculate that, this should be added to the investment in the associate with a corresponding increase in retained earnings. Okay, so there is the clear 3 marks going for the written part about the initial part of the investment. So that's how you would write that. Now, ideally, I would have written it in there, but obviously I can't copy and paste it, just so you know. So then the second bit is on the 31st of December. So a whole year later, it acquired 45% interest in shares and gained control. So this is where we're now saying it's now a subsidiary. Cash consideration of 15.1 million and 1 million equity shares, which are fair value of 3.2 each. So that's how we bought that extra 45%. We bought it through cash and shares issues. So we would have issued those shares to the previous shareholders of the entity, Egap. Now, on the 31st of December, Quinn's quoted share price was 5.7, and the fair value of Bryn's identifiable net assets on the 31st of December was 14 million. This is allowing you to do this goodwill calculation. The quoted share price is going to be used to fair value the previous holding. The 14 million is your fair value of net assets, and these two are your extra consideration to be added to the fair value of the previous holding of 25% to get your goodwill. Okay. They reported, which is what I was looking for, 2 million in with no other comprehensive income. So basically, this is what we're going to be equity accounting for. because they haven't done the equity accounting. So if I open up my spreadsheet now, because I'm going to try and do this all together, my working one is going to be the associate accounting. And they don't worry about spelling mistakes. The investment in goes in at cost. And if we come back, we find that our investment at cost, they told us, we can get back to it, was 4.3 million. So the investments goes in at cost, and they've correctly done that, right? So that's 4.3 million. But remember, that's in financial assets, okay? Then we need to equity account. And so we need to do our share of profits. And that is basically going to be 25% times the 2 million. So we just simply put in 25% times 2, and therefore that's the 0.5 which I referred to in my Word document. Let's bring it back up. So you see 0.5 million working one. So the investment therefore needs to be in the accounts, that plus that, which is 4.8, and that would be the equity accounting. Now, why don't we put the adjustment through straight away? Because they've made an error. So you're going to put your adjustment through to get those adjustment marks. We're doing part C now at the same time as doing part A. And so financial assets, we need to take out the just check the figure, 4.3. So if you go down and you minus 4.3, and you need to then put in the investment in associate of 4.8. And obviously we need to equity account, so we need to put in 0.5. So that journal is taking out financial assets. Oh, I wonder who's, I'm going to mute somebody. Is that Matteo? Take it out of financial assets, put it investment in associates, and then add it to retained earnings. Is everybody happy with that? Is there any questions? Just checking my chat. Okay. So it's probably good to say working one and then say associate, just so they know equity account. And then hopefully that's clearer to the examining team what you've done. Associate equity account. I'm obviously not making everything look amazing because you just need to be obvious about what you're doing. And there's your journal, your first journal done. Okay. So that needs to go into associates. And that needs to go into retained earnings. That's where my journal's going, making it very clear. So I'm getting the marks for all of that at the same time as writing about it. Right, so now let's go back to here and see what else we've got to do. So now we have now got to convert this into a subsidiary. And in order to do that, if I show you my notes, just to bring you back to where I've done the notes, this is basically changes in group structures. And we are now going from significant influence, which would be B, all the way over to control. And when you do that, you have to do a profit on derecognition. You fair value the investment at 25%, and then you take off the carrying value in the group accounts. Now, remember that we have changed that to be equity accounted. We then put the fair value of the investment, that 25%, in our goodwill calculation to be added to the rest of the consideration. We calculate NCI and we take off fair value of net assets, and that now gives us our goodwill. So that's what we're going to be doing now with this. They have given us a fair value of the Brins shares at 570. So I'm going to go to my spreadsheet and I'm now going to fair value it. So that's now going to be my working two. So I'm going to do the profit, or you can call it a gain, on derecognition of associate Do not worry about my spelling, right? So I'm going to fair value the 25%. And the way I'm going to do that is I'm going to take the number of shares. So number of shares, remember, they have 5 million. So it's always, go back and look. They had 25% and I'm going to value it 570. So go back to the spreadsheet. I'm going to take 5 million shares times 25% times by 570. So I'm going to put that in there. So it equals 5 times 25% times 5.70. Now you don't have to write that out because we can see what's in your spreadsheet if you do that. I'm just writing it out just to give you an idea of how it's being built, and so you can see it later. The carrying value is what we have above. So whatever you put in as the carrying value now is an own figure rule mark. So if you didn't equity account for it and you just keep it at 4.3, that one follows through. And therefore it's now a gain on day recognition, clearly said that now goes to there, 2.3. Need to put that gain through. So the gain on derecognition goes through the accounts. So working 2 is the gain on derecognition. And we are going to derecognize the associate and put it into goodwill. So what we do is we take out the 4.8. We put it into goodwill consideration, and I can't remember what it was now. Go down. This is why it's always best to reference your workings. 7.1. And we then put the gain through, and that will be 2.3. So we've already now done the derecognition and allocated it to goodwill. So you just got to remember you've already done that when we come to the goodwill calculation. So gain on derecognition, I'm just going to show so it's clearer. It's very good to make sure you show all what you've written in the cells, so because when it comes up on the marking screen, they can see it too. So let's now go and see how I explain that in my Word document. So I'm going to obviously copy and paste it in. This is what I did. So you've got to pretend I'm writing this and how long it takes to write. So I would then probably head up gain. So they know I'm talking about the gain and clearly identifying it. So on the 31st December, it obtained control by acquiring the majority rights. This is known as the step acquisition or control achieved in stages. The previously held is remeasured to 7.13 in working 2, and the gain on remeasurement working 2 should be recognised in the consolidated statement of profit and loss. And then I would put retained earnings. Okay, so there we go. So that is there. I actually think also here, this should be added to the investment, so the corresponding increase in retained earnings. We should also say share of profits is generated and added to the profit and loss. Now I'm putting in now this for a reason. In the investing section of the P&L. Now that is really important now because we've got IFRS 18 and they're asking us to make sure we say where we put things in the P&L, which section, investing, operating or financing. And share of associate profits, because we're investing, goes in the investing section. Extra brownie points might be given to it, so just keep yourself in the game. That's what I'm trying to say. So that's what we've got there. So we've got those marks coming and the working marks are coming as well. And also the adjusting journal marks for Part C are coming. We're now going to go on to the next section. And it says, in the draft consolidated statements for the year, Bryn was treated as a subsidiary and accounted for using the acquisition method. So it's basically telling you they have absolutely already consolidated. The only issues are, though, non-controlling interest was measured at the proportionate share of the fair value of net assets, but the policy is to measure it at fair value, so that's an error. And goodwill in the draft consolidated was calculated as follows. No accounting entries have been recognised in respect of the equity shares. So we haven't put these equity shares into consideration, but we have put the cash. We haven't put the fair value of the previous holding into consideration, and we haven't calculated NCI correctly. So now the best thing to do before you write about it is to create the journal for these corrections. And don't forget, what did they say? You need to include a revised calculation of goodwill. So let's do the revised calculation of goodwill, and then the journals to correct will come out of that. So we're going to go down and do now the revised calculation, which is working 3, our goodwill. And so we start with the cash consideration. Don't write anything else than that. 15 point, this is where you have to move things around so you can see them better. So we've got 15.1, which is what we needed for that. Now we need to do the share. Oh no, let's do the fair value of previous holding, because we've already adjusted for that, don't forget. And that equals 7.1. And remember, we've already adjusted for that in working 2. Then we've got the share consideration. Oh, sorry, I've got to retype that, sorry. Right, so the share consideration is basically, we issued 1 million of our own shares at 320 each. So it's simply going to be 1 million times by 3.20. And you're going to say, well, why is that so hard? Well, it's the other side of the journal that's the issue, okay? It's the other side of the journal that's the issue. So we then need to make sure we adjust goodwill. So don't forget, we adjust goodwill for this. And I'll show you that in a minute. So this is our new calculation. I want to put in what their old calculation was. So the old calculation was 15.1. They had that correct. They didn't have that in, so we've already adjusted for. The share consideration, they didn't have in. So what you've got to work out is what is going to be our adjustment. All right. And our adjustment is obviously going to be that minus that is 0. Okay. Why is that not showing? Yeah. Okay, so that's what we're trying to do. We're trying to adjust. Here, they never had that in. So the adjustment has got to be that minus that. Oh, this is really annoying. Why they haven't got the... Just making sure you can see all the figures. And of course, they haven't got that in, but we've already adjusted for it. Okay, so that was already adjusted in working 2, so we don't need to adjust for that. But how do we adjust? How do we adjust for this? We've issued the shares. So we therefore need to add it to goodwill, and we therefore need to create a share capital and share premium, because that will be the other side of the entry. So that's the next thing we need to adjust for up here. In working 3, we need to issue the shares. So in working 3, we're going to issue the shares. Actually, we can make that bigger, that way. And so we're going to add them to goodwill, which is 3.2, and we're going to issue them. Now, remember, you've got to put them in share capital and share premium. It doesn't say share premium, but you've got to use that as your share premium. You need to go back here and check what your nominal value is. And so 1 million of $1 equity shares. So that's telling you that the nominal value is 1 million. Come back, 1 million. And the other reserves, therefore, is your share premium must be 2.2. So again, those marks for part C, adjusting that goodwill calculation is therefore done. The next thing we have is NCI. Now they have calculated NCI as 4.2, which is wrong. We've got to use the fair value. And how do we fair value NCI? Well, we use the same share price as we used before. So it would be the 570 now times by the 5 million shares in issue times by the NCI percentage. And they've given you the NCI percentage there of 30%, but it's easy to work out because it's 25 plus 45, which obviously means 70. So therefore 30% is what we're going to be doing. So if we put that in, it's 5 times 5.7 times 30%. So NCI is 8.6. So we now need to adjust NCI for that error. Why it's not working. So it needs to adjust NCI. So we adjust goodwill and NCI. And we're going to do it at the same time. So up we go. We're now going to put that adjustment through, working 3. And we're going to put through NCI adjustment. So we're going to add it to goodwill and then add it to NCI reserve, 4.35, and add it to NCI reserve, which is down here, increasing both of those. So remember, I know it's a debit there and a credit there, but obviously you're increasing a credit. So you've got to make sure you're doing it the right way. You're not reducing NCI, you're increasing it. And then the fair value of the net assets is correct. So it's minus 14, minus 14. So we don't need to adjust for that. And so the goodwill is therefore the sum of those figures. And we have now created a revised goodwill. And so if you want to say revised goodwill. And the other goodwill, if you want to just make sure you've got that. You copy that across, as you can do, is 5.3, which is what they had originally. So we've now adjusted that by showing that we don't need to adjust that. That's okay. Working 2, we've adjusted the share of the previous 25%. We've adjusted share capital and share premium, and we've adjusted NCI. So all the adjustments are done for that part of the question. So for part A, they're all in. We now need to go to the writing bit and write about this goodwill calculation and reference our goodwill calculation because that's what was asked for. So are there any questions so far? I just don't feel like I'm rushing, but so now I'm going to type in goodwill and explain the errors. So this is a perfect answer, by the way. We are going to end up with a more than perfect 10 marks, okay? So what you've got to work out is this answer that I'm doing is probably more than 10 marks. So if you don't get all the marks or perfectly written, you'll still probably max out because we're getting all the calculation marks for these workings and we're getting the written marks for explaining what was going on. So the shares issued as part of consideration should be measured at 3.2, so showing us how it's calculated. So because I did the calculation in the spreadsheet, I don't need to show that. I'm just going to reference working 3. A corresponding credit will be posted to equity. 1 million goes to share capital and 2 remaining goes to share premium. Therefore, that's explaining that first error. It has a policy of making non-controlling interest at acquisition its fair value. Therefore, it should have been recognised at 8.55. And so you can take that out and put it in working 3. The NCI must be increased by 4.35 million. We again do not need to write that in because it's in working 3. The goodwill calculation, a revised goodwill calculation, is provided in the spreadsheet working 3. Don't even need to say working 3 in the spreadsheet. So probably at the top, you can write spreadsheet workings or something like C spreadsheet for workings. It makes it very clear to the marking team where those calculation marks are coming. So that is part A done. Okay, that's part A. And don't forget, you will have had the requirement at the top so that you can see that that was part A. I can't paste the requirement into my Word document, unfortunately. So I will obviously save this, and you can obviously have this as reference for when you do it yourself, shall we say, when you have to repeat this. Okay, so I'm now going to go and have a look at the defined benefit and pop that through. So let's close this up. This is what I want to close up. So we now look at the defined benefit plan, and we need to state, using Exhibit 2, explain with calculations how to account for the defined benefit plan. So this is another 8 marks, okay? So if we look at defined benefit plans and just check your understanding of them, we're going to go on here. So here in the notes is a defined benefit plan. So defined benefit plan, I don't want to do it like that. Let me bring it down. Okay. So the defined benefit plan, remember the pro forma is you do the brought forward position, you do an interest cost, your contributions come off, and your current service cost is an expense, your past service cost is an expense, your benefits paid are a contra, and then you have a remeasurement figure to take the brought forward to the carry forward. And then the journal is to increase or decrease, or whatever you've got, a pension asset or a deficit. You then put it through the profit and loss, you put it the interest through the profit and loss, and you put the remeasurement through OCI. Cash contributions are taken from the asset or reducing the liability, and the other side is obviously cash. So that's how a defined benefit scheme is done. The issue in this question, which you will see, is we have an amendment to the plan. And this is a past service cost. Now, when there's an amendment to the plan, we need to adjust the interest cost based on when the amendment was. So if amendment is partway through the year, we use the interest cost up to that amendment, and then we apply the interest cost past the amendment to the remaining outstanding liability. So that is going to be the complication in this question. Okay. So let's show you how this works. Now, the best thing to do with this is to do the calculations first and then write about it, just so you're clear. So let's do the calculations as we go, and I will be doing those in the spreadsheet. So I'm going to now open up working 4, defined benefit plan, and then I'll be referencing this as I go. So remembering, you always put in opening position, and then you'll always need a closing position. And you then need to remember what goes in the middle. But let's read it through because there is a bit of a difference here. So Egap has a defined benefit plan, and the net defined benefit obligation of 7 million was reported as a non-current liability. So in non-current liabilities, in here, there is a pension. Now, there's obviously other non-current liabilities, but there's a pension. So the pension goes in, first of all, I always do it like this. If it's a deficit, I always put it in as a minus. So that's our opening position. Then on the 1st of April, the plan was amended with effect that the present value of additional benefits was 4.2 million. So I've got a past service cost to go in, past service cost of 4.2 million. We're just going to pop that down. So that would be, amendment means it's an increase. So that's an increase in a deficit. A curtailment would be the opposite. That would be a decrease in a deficit. Because we're providing additional benefits to them. So therefore is an increase in an obligation. So after the amendment, the plan was determined to have a net obligation of 12.9 million. So after the amendment, there's an obligation of minus 12.19 million. So to get there, let's make sure we can see that, minus 12.19 million, we have to put in an interest cost and we have to put in a current service cost to that date. So the obligation, you can put it in as the 1st of April. So after the amendment, the plan was 12.9. Because the improvement in terms of monthly service costs changed from 0.3 to 0.35, and the interest rate on the high quality bonds up on the 1st of January was 5 and then rose to 6. So the interest cost is going to be based on 5% times by the 7 times by however many months it is to the 1st. So that's 3 over 12. So I'm going to do equals minus 5% times that figure. Oh, I don't need the minus then, do I? Times that figure above. Times. And then I'm going to do times by 3 divided by 12. And that therefore should give me the figure I need automatically. Just going to make this all the same custom figures. The current service cost we've been told for 3 months is 0.3. So it's 3 times 0.3. And therefore that's going to be 0.9. I can do that in my head. And don't forget that's also a minus. So actually, if you want to check that that works, you can add that down and you can see that that does come to the figure I said, minus 1219. All right. Now, don't worry if it doesn't. You've just got to keep moving on because you've got to work out, keep going. All right. So now we have to repeat all this again going forward, not the past service cost, but so you can delete that. We need to now repeat the interest cost. And this one is now going to be at 6% for on the 12.19 times by, I'm only writing this out so you can see what I'm doing, 9 over 12 for the next year. So it's going to be 6% times that times 9 divided by 12. The current service cost is now going to be 0.35 times by 9 months. And I'll have to do that, minus 0.35 times by 9. And then it says the actually valued, the net defined benefit obligation at 10 million. So the closing obligation is minus 10. And then the only accounting entry posted in the year was to recognise cash contributions of 4.1. And this was taken to the profit and loss. Now that's an error. That needs to be taken out of the profit and loss and put into this obligation. So we're going to put the contributions here. And that is going to be added back because it reduces the liability. And then everybody should now know that we have to put through remeasurements to reconcile, which goes to OCI and is the balancing figure. And so what we do is we go equals that minus the sum, and don't do it all the way, from that point all the way down because we've fixed our point. Now, if we didn't have the first bit, then it would be obviously from the top. And so that now is a gain, just so you're clear. So we've now done all the calculations of the defined benefit scheme, and you therefore now need to tell the examining team what you're going to do with it. So that is going to go to retained earnings. So's that. So's that. That is going to go again to retained earnings, retained earnings. That is also going to retained earnings because it's been put there in error. And that is going to go to OCI. So when you do the journal, it's clear where we're putting that through, because remember, we've got to put this journal through. So let's reference working for and put the journal through. And so I'm literally going to do it in one go. So I'm going to do interest. And first, I'm going to put current service cost. And I'm going to do past service cost. Then I'm going to do contributions. And then I'm going to do OC, or I'm going to do OCI. And they're all basically on working for, so that the examining team can see that. It didn't work, sorry. Oh, don't know why it's not working. Maybe I just pull it across. Thank you. So remember, all the adjustments are going to be done. Sorry, I'm trying to move the spreadsheet now. There we go. All the adjustments are going to be done based on the non-current liabilities in this section. So you know it's there. So you've got to do it basically between retained earnings and other reserves. So the first column is going to be, we are going to increase, the liability. And we are going to reduce retained earnings. So the best thing to do is to go straight to the interest cost, add that, and add that if you want to do it separately. Then we're going to do current service cost and that and that. Then we're going to do past service cost, which is this one, that. And then we're going to do the contribution. Now remember, the contribution needs to be backed out, so that would be a gain to retained earnings. And then we're going to do the remeasurement, which is a gain to other reserves because it goes through other comprehensive income of that. Now, all those, therefore, need to go through non-current liabilities, and you just do a minus and reference the above. So Control-C all the way over. Doesn't seem to be working. So I'm going to have to do it by hand. Or maybe if I pull it across, that might work. And that's all the adjustments through. And now I don't know why we can't see them, so let's just make sure we can see them all properly. So that's all the adjustments done for the pension. I am not going to total up the final column. That's done, all right? You won't get any marks for totaling up the final column. You only get marks for the adjustments. And those adjustments, just so you know, are worth 12 marks. All those adjustments that I've just done are 12 marks. The calculation for part A and part B are given when in these workings, all right? And then when you write about them and reference them, that is where the further marks will come. So now let's go to writing about this scheme. So let's put the pension in now, part B, which is now the pension. And I'll show you how you therefore then write about them. So the pension, I don't know why it's done, don't like it. See calculations and working for in the spreadsheet. And then the amendment improves the plan for members and increases the obligation. This is a past service cost and should be recognised as a full expense in the P&L when the amendment occurs. Notice I put operating section of the P&L. Interest should be calculated for the first 3 months based on the opening net obligation, and I've put in the value. After the pension plan amendment, the remaining 9 months is 6 months discharged from the revised, put in the value. Interest goes to the financing part. This is the IFRS 18 of the P&L. The total current service costs, if you want to add them up, goes to the operating section. And cash contributions must be removed from the profit and loss and treated as a reduction in the net pension deficit. The remeasurement component as a balancing figure to get the net obligation, this will go as a gain to OCI. So that is that complete. So the Word document is used to answer the question, referencing everything you have done in there. And so what I've tried to do is show you how quickly and efficiently you should be doing this, getting marks from A, B, and C at the same time so that it's clearer to the examining team and you're not repeating yourself by doing things in the Word document, which are easier to do in the spreadsheet, and then you're easier able to reference those adjustments. So hopefully I've shown you a little bit of exam technique. So this is 30 marks, and so you should be allocating 1.95 marks a minute, but I would just allocate 2 marks to this section a minute, so a mark. So 2 minutes a mark, and therefore that would take you an hour to do. Now that is what I've done is a perfect answer. I would not expect that of you, okay? For instance, the writing probably would be shorter in yours, and potentially you wouldn't have got all the workings perfectly correct and put all the adjustments through. But that's okay. We're not looking for 30. We're looking for about 20 to 25 of these marks. Okay, so you must move on if you've not finished. You could always come back at the end of your time in the exam and add to this, right? But you must move on because you've got to cover the whole paper. Now, it may be that you get to say question 3 and 4 and you don't have much to say, but you do have enough to say to at least do part of that question. And you may save time and then be able to come back and fill in the gaps here. But never, ever go over time on question 1. It's a game changer if you do, because it means you're going to lose time the rest of the paper and probably not pass.